G'day YouTube, Max right here, and Friday night, I'm a few beers in, no milk, no sugar, just as you would expect. And I was asked to do this video in one of the comments of my previous video and respond to Benjamin Cowen in this video. So I'm not thoroughly familiar with Ben. I do watch his channel a little bit every now and again. And guys, I want you to know at least I'm gonna challenge some of the ideas he puts forward in this video. Please understand, I'm not attacking Ben, and likewise I did a similar video about Alicia Rastani just the other day. I'm not attacking these people at all in any way, shape or form. Questioning the ideas, might have a difference of opinion, but respect for these guys. This is trading. I mean, you're wrong 49% of the time and you're right 51% of the time. That's the game. So I'm not attacking anyone here, but I just want to call into question some of the ideas put in this video. So I'll try and encapsulate Ben's thesis here. And the thesis is that these curves here, they're what's called logarithmic regression curves. And this shape is just logarithmic, okay? It starts out steep and progressively gets flatter and flatter and flatter. So I'll say at the outset that I've used these kinds of charts before. Specifically on this channel, you would have seen rainbow charts used in years gone by. So just so you know, I'm not critical of this overall as a concept, but I want to be aware of the limitations and where it puts it in. So right here, he's making the claim, or his thesis, I should say that. His thesis is that what this is helping us see is that the degree of the uptick is reducing, right? The degree from this high to this high was a greater multiplier than from this high to this high. Same is true from the lows to the lows and the lows to the lows. Also, he notes that the amount of time we spent at the bottom of one of these bands was this length of time, and it got bigger, and therefore he is forecasting an even longer period of time. And with this and a few other data points, he comes to the conclusion that people who are predicting 2021 to be a big year have got it wrong. He's suggesting that 2021 is going to be a yawn, 2022 is going to be the interesting year, maybe even 2023, and that's when we're going to see a big bull increase. Look, that can absolutely play out. But some criticisms of the thesis. First of all, well, actually, before I move that, I'll show you a second thing. He goes on to show a second chart. This chart seems a bit of a whatever because you'll see that the peak is on the green line, the peak is on the yellow line, the peak is on the red line. And just by changing the base of the log or the coefficient or doing something, you can come up with a much better chart. Which is this chart right here, which he also has in his video, to be fair, not trying to take that away from him. And I just think it says the same thing in a neater way. In this particular one, you choose the correct function so that it kisses all of these points along the bottom and along the top. And it's showing that the same logarithmic, the steepness is going down over time. So, okay, now that I think I've done a half decent job of explaining his thesis, again, this graph was saying the same things. The ups are getting less steep and it's going to take longer to achieve the next big high. Okay, so first of all, these dotted lines, they're super important. They are the Bitcoin halvings. If you've watched my channel for a while, we've talked about these a lot. These are the foundation, in my opinion, and I think the vast majority of people's opinion, of the Bitcoin 4-year cycle. Now, this is the entire history of Bitcoin. So way down here, we have Bitcoin start in 2009. That's when Satoshi mines the first block. And we don't even have a price for Bitcoin until 2010, when for 20,000 Bitcoin, someone buys someone else a pizza. And boom, we have a price. And even that probably happens well before this chart is enabled. And this chart is probably going way back to Mt. Gox was the first exchange to kind of do it, right? So it's kind of amalgamating data from Mt. Gox, and then after Mt. Gox went bankrupt, other things. So what I want to get at here is, in my opinion, everything before the first halving is irrelevant. Just delete it off the map. We have flat line for 2 years, and then something, and then whatever, but we go from zero supply and zero increase in supply, and then we have a halving. So that's not a real thing. Now from halving to halving to halving That's different. That I'm going to start looking at that data and saying, okay, I'm going to look for trends here. But before this first halving, because we're not going from halving to halving, we're going from non-existence to halving. And so I discount all the shit on the left-hand side of this first halving. To me, it's not showing me a lot. So if in your mind's eye, block this out, now you come up with an interesting question. Actually, as long as we're staying here, I'll make myself a little bit bigger so I'm easier to see. There you go. So the left-hand side of this, I discount for the reason that I just said. So now, if we've deleted that in our mind's eye, let's look to the right. What have we got to work with? We've got one high and one high. 2 data points. 2. With 2 data points, I can put a linear line here, I can put a parabolic line here, I can put a logarithmic line here, I can put anything I want in here. It's not enough data to be seriously significant. On the downside, you could say we've hit a few more points. We definitely have hit a few more points. We've hit 1, 2 was a prolonged period in here, and then 3, and then 4. So on the downside, I can totally see that we have some more points, and I think it has a little bit more validity. But still, this is not statistically significant stuff. Now, looking at it by itself, you say, well, that's a pretty interesting chart. And like I said, I've used it on this channel here before as well. So I'm like, okay, this is an interesting chart, something interesting. Combine that with the knowledge of what we think this is. We think this is a cycle built on the back of halvings, right? This is something that is caused by the Bitcoin block reward halving every 4 or so years. Again, that's represented by these dotted lines. So in order to fit this graph, we've got 2 options. We can take the option that Ben's taken, which is to say the peaks and the lows are lengthening. The time so the time it takes from peak to peak, we should expect the next peak to be much longer than this amount of time, right? Or we could just say the price isn't going to go as high and we can achieve the same result and it still fits the curve. So you've got 2 ways to solve the problem if you subscribe to this thing. So step 1, I suggested we've only got a couple of data points. I'm not putting an enormous amount of stock into this. Okay, put that argument aside. Step into the next argument. Let's assume this is a valid argument and we're going to try and draw something from it. We can draw 1 of 2 things from it. The length of time that it takes for the cycle to play out can increase, or the size of the high isn't going to be as significant. Either way solves our problem and it fits this chart. So now, combined with the fact that we had, we understand, I think it's pretty much a consensus almost, that 90% plus people think that this cycle is generated from the halvings. Well, the halvings are every 4 years. They're not changing. Like by his thesis, this is going to be longer. We're not going to have a high until 2023, which is about the time of the next halving. Presumably, he thinks the cycle after that is going to be 6 or 7 years, and there's going to be 2 halvings in the one cycle. And all of a sudden, cycles become meaningless. So for me, it makes 0 sense to alter the time that's saying that we're speeding up. We're speeding up cycles, and the cycles are going to get further and further apart. I don't buy that at all. I think if this is true, and if I wanted to adjust my predictions based on what's in this chart, I would reduce the size of the bull run, meaning I don't think it's going to go to 500 or 300. Maybe it cuts out at about 100 or something like that. And if we look at it, yeah, it is. It's about 100. Now, if you subscribe to the thesis in this chart, then you would put the bull market run at about 100. And again, typically they happen about 1/3 of the way through the cycle. This is about 1/3 through the cycle. This is about 1/3 through the cycle. And so about 1/3 of the way through the cycle, which again is going to put us close to the end of 2021, maybe early 2022. Then all of a sudden you've got that $100,000 mark. That's, if you're going to use this chart, that's the one to take. I can't see any reason why I would ever extend the time frame, because the 4-year cycle is a 4-year cycle. It's based on the halvings. The halvings are 4 years apart or so. They're not getting longer. I wouldn't expect the cycle to get longer. To argue the cycle gets a little bit more muted each time, that's more valid for me. That's more valid. Let me think. Is there anything else I wanted to share with this? No, that's it. That's what I want to. I'll wrap it up there. Guys, like, subscribe. Thank you for the great question. I believe it was Batwing. Batwing, thank you for the question on my previous video. I greatly appreciate it. It inspired this video. Like, subscribe, share, do all the fun things. Another fun video coming for you soon. And I'll see you guys soon. Take care.